All right, good afternoon, everybody. Uneducated Economist here. I got the Ken McElroy with me today. Ken, thank you so much for taking the time to speak with me today. Ken is like the man when it comes to real estate, new development. Um, we had a great time down in the Rebel Capitalist. That's where I actually met you in person. And man, what a great time we had down there. So do me a favor, Ken, introduce yourself, kind of let the viewers know who you are and what you're all about.
Sure, sure. Thanks. First of all, thanks. It's been great. I really enjoyed meeting you and going on your stuff and watching your stuff. I think it's a great approach. Um, so just for anybody who might not know, so I started like a lot of people out of college. I started renting apartments for other people. I was in the apartment management, property management business. I quickly realized I needed to be an owner, not a manager. Started buying them in my late 20s, single families and all that. Fast forward 30 years, we bought a little over 3 billion in assets. I own 2 billion right now. I have a company that's around 300 people, and we do acquisitions, development, construction, primarily multifamily. So we do ground up construction. I own office buildings, self-storage. So I'm really in the commercial sector as opposed to really more residential, but we are a builder. So I do know what's going on, with lumber and concrete and OSB and, all that kind of stuff, and the labor and all that kind of stuff. So I have my hands in lots of different things. I'm based in Scottsdale, and, I just flip and love this business. So anytime I can chat about it, I'm happy to do it.
Oh, that's great. So, I guess everybody's wanting to know what's going on in the real estate market. So, really, your expertise is more in like the new construction, right? New property development.
Both, yeah, absolutely. We do a lot of value add stuff. I'm a long-term owner. So unlike a lot of people where they buy something and try to time the market and sell it for higher, that's not at all what I do. I'm really a passive income guy. 20 years ago, I wrote the book, The ABCs of Real Estate Investing. When I met Robert Kiyosaki, who wrote Rich Dad Poor Dad. So Robert is one of my, he invests in a lot of our projects. So, we've had just a lot of experience in a lot of different things, not just construction.
Okay. And so we've gone through some serious changes over the last year or two here when it comes to the new construction market. Like,
Yeah.
kind of tell us a little bit, like, what was the environment like, say, 2 or 3 years ago, or even 4 years ago, comparatively to what we are experiencing now? Because we've had a dramatic change in the way properties are developed now, right?
There's a lot of differences. Yeah. So what happens in a real estate cycle, you can imagine, when when there's really not a lot of financing and there's, let's say, high vacancy, that's when land prices are low. That's when development prices are low. That's actually when you should be doing it.
Yeah.
Then what happens is, as the demand comes, people are like, oh, there's demand, we're going to build. So, we're experiencing this asset bubble right now, and a lot of it is driven by lack of supply. So, lack of supply can happen all kinds of ways. So you think about it can be when there's high price of land, high price of construction, and the rents don't work, right? So you're not going to build. So really, there's 3 main components, not to make it too simple, but you have your price of your land, plus the price of the building, and then your rent. So now, obviously, there's a lot more to that, but the point is, if I built something here, and I'm in Scottsdale, Arizona, that exact building, I can move it to Dallas, and it's going to be pretty close. You know what I mean? Like everything above the land, it's going to be pretty close. There might be some small labor issues and some other things, but commodities are commodities, lumber is lumber, all that stuff. So if it's the exact same project, so it's the same with a house. The variable can be the land. The land might be $1 million an acre or $200 an acre or whatever. So and then the rent. So the rent in Dallas might be $2,500. The rent in Phoenix might be $2,000. So those are the decisions that you make as you're moving forward, even on a sale price. So again, let's move. Let's say you have a single family home of 2,000 square feet, and it's 200 grand to build that home. Okay, in Scottsdale, it's 200 grand. In Des Moines, Iowa, it's 200 grand. You know, in Cleveland, Ohio, it's 200 grand. In Florida, it's 200 grand. Talking about the components. Okay, the difference is the land and what does it sell for? So in Ohio, it's going to be 180 grand. You know, in Scottsdale or Phoenix, it might be 300 grand. In Florida, it might be 275. You get the point. So the commodity itself, you know, it's actually the easiest part. You know, the land and, you know, the demand and who's going to buy it, all that stuff is actually the more complicated piece.
Okay. Yeah. And I can see where like it probably takes some serious experience to be inside of that, to be able to say, okay, well, I'm going to look at this particular area. Yeah, the land's cheap, but the rent doesn't quite cover it, right?
Right. Or the sales price. Yeah, like
yeah. But then you find another spot where it might be really expensive. You're like, man, this doesn't seem conducive, but then the rent covers it, right? So like,
got it. Yep.
Yeah.
So
that's
so that's what happens. So that's actually what drives development, right? So like you might like in the Phoenix area, there are just like in everywhere, there's, you know, the other side of the tracks, you know, like where I grew up as a kid, you know, like you would not want to build there, but you might, there are areas within areas like submarkets that can be really, really unique. And, you know, like let's say it's like a redevelopment area, you know, it's something happened. Maybe there's a stadium, or maybe there's a big shopping center, or something opens like a school or university or community college or something that, you know, kind of anchors an area. Well, that could be 3 or 4 miles away from a really bad area. So it's not always, a lot of people just say like, I'm never building in Phoenix. Well, Phoenix probably has over 100 submarkets, right? And there's some very, very expensive areas of Phoenix. And there are areas there that you would never want to take your spouse or girlfriend, you know, for a date. Like, you know what I mean? But it's still Phoenix. So, you know, so that's the beauty of real estate, in my opinion, is like you find that little piece of land in this area that's like up and coming, and you can put that $200,000, let's say, house there, and maybe the prices are in 300, but you could go 2 miles and it could be 175, you know, like, you know, based on a road or a mountain or a lake or whatever it is. And, you know, a lot of it's based on, you know, the economics going on in that particular submarket. And so that's why I love real estate, because you're never really out of the game. Like there's always something you can do somewhere in some market, whether it's self-storage, single family, a condo project, multifamily, retail, industrial. There's so much stuff going on. And so that's the beauty of it. If you see it, you can do it.
Yeah. And I think that like, even just kind of what you were saying, just that you like, you know, I mean, I'll never buy in Phoenix or whatever, or build in Phoenix, but then just kind of what you were saying, just like a couple of miles difference can make all the difference in the world on whether that project, I mean, literally just turning down the other street can be a major difference. And so again, I think that's probably more of like the experience that you've had within the real estate game that kind of gives you that almost the instinctual thoughts when you're driving through the area saying this is going to work, this isn't, kind of thing. That's pretty incredible to even like trying to wrap my head around it, because I think about real estate investing.
Well, I always say like, okay, there's an acre sitting vacant somewhere. Okay, as people drive by, what do you see? Like I see how many, you know, can I get a 4 unit or 8 units on there? A custom home builder sees 1 home. You know, a self-storage person sees, you know, 200 self-storages. You know, an office guy, he'll see a 2 or 3 story office building, you know, 30,000 square feet. So like, you know what I mean? Like everyone, you know, even though we're all real estate people, it really is like, what do you see? And so as you start to get experience, you can stack all that stuff together. And then you're looking at that acre and you're going, what can I do? I mean, can I put an RV boat storage on it? Can I, you know, will fit a billboard? Is this a good, you know, which I'm in the billboard business, you know, so like all that stuff, you start to look at the possibilities as opposed to, you know, can I build a duplex, you know, and that's it. And so I think that's the beauty of the business.
Yeah, is to have that vision, to be able to look out there on the land, look around, say, yeah, this could work, you know, and say the school's over there, the shopping center there, this is the perfect location for it. Yeah, to be able to see that kind of thing. That's, you know, that's probably something that's not really taught very well, right? I mean, that's something that you really have to be like in the mindset for it, you know. You just have to kind of be stuck there. What's it like building right now? Is it tough? Is it a
Oh,
hard
without a
market to be
doubt.
in?
Yeah. Well, you got to look at all the factors. So one, there's obviously, on that same acre, there's what's called zoning. So let's say it's zoned for one home. Okay, well, one home doesn't work financially. So how do we increase the zoning or increase the density? So if I can put 8 homes on there, or 6 or 4, all of a sudden that same price acre starts to make sense, and so you have that issue. And those cities and counties right now are, the bureaucracy and the politics, to get a zoning change can be problematic. That's always been around, though. It's not new. But then there's what they call impact fees, which are simply, okay, if I put a fourplex here, how much is it going to cost me to plug into electric, plug into sewer, plug into water, and all of that. Like, so there's that. And do I need a curb cut? What's the entrance look like? Do I have to redo the sidewalks? And so all that stuff is, has to be approved by the city or the county. So you have to have all that. And then you, of course, have the neighborhood that says, we don't want that here, NIMBY, not in my backyard. So you have that. So you have the city council things and all of that. So there's all of that. But by the way, that's always been around. So that's not new. That's not economic driven. The issue we have today is the price of commodities, the supply chain issues. It's hard to get appliances, and if you do, they're 30-40% more. It's hard to get labor and trade because inflation's killing people, and and you have to pay them more to show up. Even just little maintenance guys. We have like 50 maintenance guys. I was paying them maybe $20 an hour a couple of years ago. That doesn't cut it now. You're closer to 30. And they're the same amazing people, but their rent's gone up, their food's gone up, their gas has gone up. And they're getting hammered, and so it doesn't work at 2 or 3%, wage growth like it used to. So anyway, that's everything else to actually build. So the building costs have gone up, 10 to 30% depending on the type of building. I know it's a big range, but if you're heavy in concrete, it's one thing. If you're all sticks and bricks, it's different. If it's lumber, let's say, 2-story construction is different than single-story. There's a bunch of things that determine what it costs to build something on an acre. So all of that, and then the worst part, as is of course the financing. So most people don't have all cash. So if something's going to cost $200 or $300 to build it, they're going to go to a bank, and they're going to maybe have 20-30% down. So call that $50,000-$60,000, let's say. And then the bank's hopefully going to give them the rest. And but the cost of the cost of money has gone up so much. It's probably in the 6-7% range, whereas a year ago it was 3%. So all of that factors into that one little acre.
Right.
And what happens is you're constantly trying to solve to do it, but you're getting killed. The construction costs are too high, or the cost of debt is too high. And so you just walk it. So that's actually the biggest issue right now. And people, we can't build for the prices.
Yeah, well, let's elaborate a little bit more on that, because that was going to be my next question. Are the builders in fear right now? I mean, is the uncertainty so dramatic right now that they are just kind of backing away from these projects, thinking, man, I don't know if I can build this thing and then be able to sell it and get my margin, make my profit margin off of it, or even break even. If that's such a concern, I can see where a lot of people might back off on the projects. But if that's the case, wouldn't that kind of put a gap in production, leaving a limited amount of new construction to come onto the market? I mean,
yep, that's exactly what's happening. There's gaps being created. So I'll give you a couple examples.
Okay, great.
Imagine, 2 years ago, you walk into a subdivision and there's a couple models there, and it's just a home building. Sit down with the leasing or the sales agent, And they go, this home is 250. And you're like, awesome. You put a deposit down, and you're like excited, new home, it's gonna be built, you pick the lot, all that stuff, and it's 250. Okay. At that time, no lender can lend on it because it's not built. The builder commits to a 250 number, but their costs go up. So now they're actually building it for no profit because it's a hedge. It's a hedge for the buyer. By the way, that is the way it's been, and there's nothing wrong with that. A buyer should know definitively before they walk away and put a deposit down what it's going to cost. So that's what caught all the home builders in the beginning. Imagine that. So they had a contract that said you have to deliver this at 250, even though the builder might actually have been losing money now. Okay, so all that chaos was going on, and then at some point they said, you can't do that anymore. You can put a deposit down, but we can't tell you what it's going to be because we don't know what it's going to be. Because our lumber is going up, our concrete's going up, our labor's going up, our appliances are more. So we can no longer rely on all the fixed costs or even though they probably built some margins in on what it's going to be and what we're going to deliver to you. So now the buyer's like, I don't know if I want to get involved in that game. Why don't you go ahead and build it? And then I can decide later, which is smart because also I haven't even brought in the financing component. Back then it was 3%. Now it's say 6%. So they're like now, so my cost of my client, now my mortgage payment is another $1,000 plus the builder actually, that same $250,000 house might be 260, 270, 280, 290, 300, whatever. So they're going, which is fair, so the builders, so there's this pickle, and to your point, there's a gap. So that's why everything's slowing down. So the buyers are saying our cost of capital to be able to get financing is, I think last I looked on a $450,000 home, it was about $1,000 more than it was a year ago. So you imagine that. So the buyer has $1,000 more for the same house that they have, and the builder is now actually delivering that house at less margin because their costs are up. So what's happening is the builders are slowing down because the buyers aren't there because interest rates are high, right? So all that's happening at the same time, and they all are valid points, I wouldn't buy something not knowing what it's going to cost. Right. The builder is having a tough time building something, not knowing that they have somebody to buy it. And everyone's relying on the interest rates being, back to the way they were, but they just went up again yesterday, so.
Yeah. So what do you think is going to happen this summer? I mean, is it going to be a slowdown in building, or is at some point the demand for homes is just going to be there that, because I mean, the slowing down of homes, I can only imagine is building up tension amongst the buyers, right? I mean, the longer they wait and the less home sales that are taking place, the more itchy and eager they get. And so I'm thinking at some point there's going to be a point of that tension snapping, like does the market collapse, or does the buyers jump in? What do you see?
Yeah, I don't see a market collapse at all. I don't think anybody's really in the trouble that they were in 08, which I went through, by the way. I don't see that. It's very different now. There has been a fairly sharp reduction in a lot of markets on pricing. So you take a look at pricing, and the one thing, again, if you look at commercial office, or I'm sorry, just commercial, it's going to react very differently because in commercial, you have investment groups looking to make certain returns. And as the price of debt went up, they actually have to offer less, right? Because the only thing that changed is the price of debt went up. So if the price of debt goes up, their cash flow goes down. That's it. So from a commercial standpoint, I would say we've had at least a 20% repricing. I was in Vegas yesterday at a conference. I got in late last night. There were 12,000 people there. It's called the National Multi-Housing Council. It was in Las Vegas, and I had meetings every 30 minutes, man. It was awesome. So with brokers and investment guys and equity guys and debt guys. And I kept asking the same question, what do you guys see for multifamily? And they said about 20% price decrease from, 1 year ago. So that's multifamily. That's very different than single family. So single family is being actually driven primarily by migration. So people are moving from Portland, let's just pick on Portland, Seattle, and San Francisco. I'm from the Northwest, so I can pick on my home state. I'm from the Seattle area. So when, defund the police and the safety issues and, the policies around, all the things that have frustrated people, and they all moved. And not they all moved, but a lot of them moved, as you know. A lot of them moved to Florida, North Carolina, Texas, Arizona. Those are kind of the four majors. It's very simple to follow that. All you got to do is out-of-state driver's license, Ryder trucks, North American van lines. Those are all really good data points. If somebody moves from, Seattle to Phoenix one way, that's a data point. Doesn't mean that they're permanently, maybe they're there a month, 2 months, 3 months, 6 months, whatever. But again, there's all these data points that talk about in migration. So Florida and Texas year over year have gotten a net over 100,000 people. You start to take a look at the net on these. So it's just the difference of people moving in and people moving out. That data is all over the internet. That's what drives pricing. So what does it do? If somebody moves to Phoenix, like 100,000 people move to Arizona and 50 of them move to Phoenix, that's going to drive rents up. That's going to drive home prices up. That's going to get longer waits at the restaurants. So, all the things that you would imagine, harder to get into charter schools, all the stuff that go on when there's more demand than supply. And it also affects wherever they move from. So you see the areas where they're moving from going down. And then you see the areas that they're moving to kind of going up. And then you sprinkle the interest rate issue, it's okay, well, now I'm going to move to Texas, and what was, maybe a $500,000 house at 3%, I can't afford now at 6%. So I'm going to rent, so there's all that stuff going on too. And so, so unfortunately, on the single family side, these higher interest rates are pushing people into the rental market because of that affordability. So, because their wages aren't growing that quickly as well. So they're moving, creating pressure in an area, but really what we're seeing is a lot of people making different kinds of decisions on where they can live and whether they're renting or buying. And, so it's a very interesting time. It's a fascinating time to watch. And we're watching all of these because, as you can imagine, there's massive value and real estate implications going on as a result of, let's say, people moving out of downtown Portland or Seattle. We're already starting to see it. We're already, they're coming after us. I say us, people that own real estate for property tax increases, and things like that. And then they're also saying they're putting rent caps or rent control in place. So they're saying, oh, we're gonna control your income, but we're also gonna grow your expenses. So the smart money is going, all right, I get it. You can do whatever you want, but I'm gonna go here. Smart money goes where it's treated best. And so there's lots of money decisions being made. So that's also not good for a market when somebody in Wall Street is saying, we're not going to invest in Portland right now because of what's going on politically, and expenses are high and they've got these things going on. So we're still going to invest. So we're gonna put that money in Tucson, or we're gonna go to wherever. And so I'm not trying to be political here. I'm just saying that's what's going on. People are saying, do what you want to do, but we're going to go where our money's treated best. So that's what's happening at Wall Street, and that's what's happening at Main Street.
Yeah, and that's it's pretty interesting that you bring that up, because I was just talking with a friend of mine who owns some property here, not only in Astoria but in Portland. Some rental income properties, and she was talking like the investment groups and all the crew that she used to run with. All the other landlords out there, they gave up. They've sold their properties and they've moved on to other states. And I think about that. It was like, if the idea of building new construction is not encouraged and the rents are incredibly high and they hit them with rent control, I have to wonder, is just like, where is the incentive to actually bring in the new residential construction? Like, it's not, there's no, it's de-incentivized actually,
Correct.
you know,
Right.
in a
No,
way.
that's exactly right. So that's what
And
I watch. And you hit the perfect, you hit it. That's exactly what's happening. So, investors like your friends are saying, listen, there's nothing we can do about this. And nobody wants to hear anybody bitching any more than you already do on the news anyway. So we just adjust, just that's what entrepreneurs do. Like, okay, I'm gonna go here, because I'm, safer, better weather, taxes are better, it's progressive. A lot of people are moving there, and that's new and it's fun. Not necessarily because they want to, but because they're forced to, because I think everybody's trying to manage, and just like you or me, how much you make, how much you have, and where's it gonna be treated best, and where does it go the furthest, right? And so they're starting to make those kinds of decisions, as they should.
yeah. And I think a lot of times, maybe some of the people who have not out there, they look at somebody who's like maybe owns some property, owns rental income, and they think just because they have these properties that there's some sort of rich millionaire or something. And a lot of times they don't quite realize, like, being a landlord doesn't necessarily mean that you have a lot of money, right? It just means that you have a lot of properties out there that you have to use as like your income. It's like your job. And so I think a lot of times when people are like, well, we need rent controls, they don't realize that that's their job, like that's their income. And if you're losing profit off of it, why would you want to do that? So the investment part of things, I think that's what people miss out on, is that if you put rent controls on there, if you make it difficult for a landlord to make an income, then why would they want to invest and bring in more properties there to ease that burden, right? And so I think a lot of people end up having this attitude that's counterintuitive to what is actually going to help them out, especially those who have not,
And I think it's a good point. I think the overwhelming majority of people, like my in-laws, they worked at Boeing in Seattle, right, which is where I'm from. And they owned a rental. Okay, one, right? And it was 20 years or something that they had figured out it was probably good to buy. The tenant paid it off for them, so they didn't have a lot of debt on it. Actually, at some point they had none. Okay, so then they retire. Okay, so now they take a look at what is their Boeing pension versus a $600,000 home that their tenant paid off, right? So I think that's the majority of the people. The majority of people have one, maybe two, that they don't necessarily want to be landlords, but they're trying not to just be all in the stock market or all in something here, and they realize that there's some power out there by not just turning their money over to a wealth manager and hoping that it's there at the end when they retire. And I hope that it is, but I think a lot of people are realizing that with what's happening with a lot of pensions, they're there what they thought they were going to be and all that kind of stuff. They're having some some rough decisions that are made not necessarily. And it's horrible because they're super hardworking people. But I always look at that example because the truth is that little house that they put a little bit down on that was paid off by their tenant actually is very close to what they did in that all those years of working at Boeing. It's very similar in value, right? One small decision 20 some years ago. They're not necessarily real estate investors, but if they sold it, it would get 600 grand in cash, and they would have taxes and stuff, of course. But it's an asset. It's part of their estate, And there are people that have done that 1, 2, 3, 4 times, and they're not necessarily, I wouldn't call them real estate investors. I guess technically they are, but they're just trying to buy one maybe every 3 or 4 years, and they stick a renter in there, and so there certainly is work, And my wife, same thing. She's got 3, and the renter pays it off, and she was a school teacher, and That's it. So I just, oftentimes we look at these real estate investors and think of them like your point, these big landlords. It's not. The majority of the industry are small little landlords just trying to not be all in the stock market and put all their wealth with somebody that they talk to once or twice a year, when they're trying to rebalance their portfolio. It's really smart not to have all your eggs in one basket. And I think from my experience, that's the majority of real estate.
Mm-hmm. So, I'm looking to get into real estate at some point in my life as well. I had come just recently out of like some pretty bad debt and trying to get my stuff together. And, I want to build up that portfolio, something that I can have generational wealth to hand off to, my kids or something at some point in my life. Let me ask you, can anybody get into real estate, you think?
Absolutely. Listen, there are a lot of people out there with a lot of BS, on training and sales courses and stuff like that. You don't need any of it. You just got to understand the basic fundamentals. Like if you have $50,000 or $100,000 sitting in a 401k, let's say, from all this hard work, or maybe you don't. All you really need to do is move that to a self-directed one, which self-directed means now I have the decision on how to use my own money. I just moved it out of something that's not self-directed, and you can use that money to invest. And so, like that's one super easy way. If you don't have that, then it's just a matter of finding people with money to go do it. And I'll give you a couple examples. There's a young man that I mentored. I have a home in Coeur d'Alene, Idaho, and he recognized me and said, can I have coffee? And he brought his parents, which I thought was awesome. And he started with a duplex. He didn't have the money. I think he was 22, 23 years old. But I love anybody that has that kind of fire in their belly, man. I'm going to give them my time. So I sat down and I said, listen, you can find a duplex. You don't have the money. What you can do is you can live in one side, rent the other side, find the money to buy the whole thing, and just pay the investor the money that you're getting from the one side. Make sure that it's enough, pay, And so he put the whole deal together. That's called house hacking. Simple. What just happened there? He's now got a partnership. He found the money. And investors happy because they get a little bit of cash flow on their money that maybe was sitting in savings or whatever. And he just reduced his cost of living to zero. So now, is that investing? Yes, but what it really did is it eliminated about $1,000 a month of his, so that was step one. Anybody can do that, and so I always tell people, real estate is what you see, period. It's kind of like that acre, story I was telling you. So what do you see? And, how can I grew up, my parents were super poor growing up. I shopped, as long as I can remember, I would go to Salvation Army or St. Vincent de Paul to get what I wore at school. So I had a mindset issue around money because my parents had a mindset issue around money. So I had to punch through that. So, that's a longer Zoom. But the point is, I had to punch through, how do I unlearn and then relearn? How do I see things differently? That's all. My parents were like, you can't afford that. Money's scarce. They had a scarcity mentality. By the way, awesome parents. That's just the way they thought. So how did I had to change who I was around in order to get what I wanted. And once I started opening my mind a little bit, like in that example, then I was like, oh gosh, I just did this. That's awesome, right? So then you go do that again. You don't have to do that again the next month or even that year. Just keep your eye open, because at the end of the day, it's all about math. So if I ask somebody for 50 grand and they get $5 grand a year in cash flow, that's 10% cash on cash.
Right.
That's it. Now, everything has to work. But if you don't understand how to do that, then figure that out, because there's so many people with money. I mean, it's beyond belief. There's so many people with a lot of savings and in the stock market, and they're getting clobbered, and they are looking for people like us to help, put something together like that so they can make more money on their money, because they're getting clobbered in the bank. You're making what, 1-2%. I mean, let's say inflation's at 6%, so you're going backwards 5%. So again, back to math, basic math. And I always tell everybody, it's all math. Every single time, the math doesn't lie.
Right. And so you work the numbers. If the numbers tell you it's okay, you go for it. If the numbers say, I'm sorry, you're going to have to pass on this one. It's like, it's no emotion, right? It's like,
Zero.
you don't even have to put in any, like, I really like this. It doesn't matter. It's like, it's the numbers that we're looking at.
Yeah. That's right. And by the way, there's way more no's than yeses.
Yeah.
I'll just give you an example. We look at probably 300 or 400 deals a year. Last year, I bought 2.
You looked at how many?
Probably 300 or 400, I would guess.
300 to 400, and you did 2?
Yeah.
Wow. So that's a lot of filtering through projects to find 2 that the numbers work.
Yeah, but I also want to put it in perspective. When I look at a deal, I'm not flying somewhere, driving somewhere, meeting with a whole bunch of people and putting a lot of effort around it. I'm focusing on the math. So I might get it into my inbox and do some rough calculations, and say, okay. And oftentimes it's an easy pass, very easy. Like, okay, this doesn't make any sense at all. Throw it in the round file, throw it in the trash. Every once in a while, one's like, this is interesting. This could work. But even then, I got to be honest, it's like high probability it won't. So, so it's pretty quick. So when I say 300, one a day, it's not, it sounds like a big number, and it is, but that's what I do. I love it, man. I'm looking at stuff all the time. And everything is a different key, and everything has a different math component to it. Every deal's in a different market. And so I think that's the greatest way to educate yourself, is to just get on as many free lists as you can, get as much stuff as you can coming into your inbox. Fix your box of what it is, like, what is it that I want? Maybe I just want to look at deals in downtown Portland, let's say. That's it. And then just do that. And then just try to figure out everyone that's doing deals in there. And it'll be the best education, because you'll get on phone calls with people, you'll be meeting with people on the stuff in your, that might look good box, right? And that's how you learn. Is not going to be in some seminar, listen to some guru that's trying to sell you into a bigger seminar. That should, I do not recommend that. Just start meeting with people that are investors. One of my very first meetings was my uncle, who was super understated. And I just was meeting with him and say, what about this? What about that? I didn't know anything. And, and he took, he obviously was family. So, he spent a little more time with me. It doesn't have to be family. It could be, they're everywhere. These people are everywhere. And they're so giving. That's been my experience.
Yeah.
And they'll guide you. Right. And if you get somebody that wants your money, or, is doing something, just cross them off your list and go to the next one.
Yeah, absolutely. Ken, it's been a lot of fun talking to you and getting some of these success stories and all this good information from you. One of the things that I like, it's not necessarily I like to hear about it, but I like to hear about the recovery of it. What was one of the worst experiences you've had? What was one of the things that has been devastating, or one of the biggest lessons that you learned that really hit you, that you would like to share?
Yeah, it's a great one. Yeah. So I've lost money. I've lost investors' money. So I bought a property in actually Scottsdale here, and I put together a group of people. I think it was $6 or $7 million, and it was a condo conversion. So we were buying something and then, with apartments, and then converting them into condos. So the quick math was buying for 100 a unit, selling for 200 a unit. Okay. Well, '08 hit, and all of a sudden that investor, the people who were going to be buying the condos, they didn't have that financing for them. So I was sitting on this inventory, right? I had sold some, hadn't sold a lot more. And I'm sitting there on this project that, of course, I could re-rent, right? But you buy it, and you're doing all these improvements and stuff. So again, the math didn't work, right? So we had to. I'm a firm believer that you don't really learn much when you're making money. You learn a whole lot when you're losing money. And so I personally, my partner and I, Ross, we personally had 500,000 each, and so we had $1 million, and we lost that. But I also lost investor money. So what I did was get them, I got them all together, and I just ripped the band-aid off, and I told them the truth and said, this is what happened. That was tough, because now it's not just me. I don't want to lose money personally, but it's easier actually than sitting down with people that you not like and took their money and you had this vision and it didn't work. So, and I know that, it was tough, really tough.
Right. And so I can imagine, going through this kind of experience, seeing all this money flying and seeing other people's monies, kind of disappearing, it makes you a little gun shy, right? Yeah, I mean,
Sure.
that kind of like, whether or not it broke your confidence, but it definitely did some damage to there, wondering, man, what's going on? So you have to overcome that, right?
Yeah.
What was that experience like? What was the next project like? Was it a little nerve-wracking? Was it?
100%. So, what happens is you learn a lot about contracts. So when stuff goes sideways, what comes out? Contract. You said, whenever a contract comes out, man, like, that's when you realize that you should read that a little bit better. Nobody pulls a contract out whenever you think about it. So whether that's in a PPM or a private placement memorandum or an operating agreement or any kind of lease or term or whatever it is, that. So one of the things I learned is that I really, really, really need to make sure that I really understand what I'm signing. I really need to understand what's in this and how all that works. And then the second piece is, how will a lender or investor or all that stuff, how are they? Was I reporting correctly? Because for me, I just want to be transparent all the time. I want to be like, everything's on the table at all times. I think that's one of the biggest issues I see with people, if they aren't, they're like, they raise new money for money that's being lost. Well, that's called a Ponzi, right? I've seen that happen. I've been pitched by a guy that got put in prison for Ponzi, so, the transparency is super important. Ripping the band-aid off and dealing with whatever you're dealing with, I think that's important. So for me, there's a lot of disclosure stuff moving forward, right? Like, this could happen, this is, and so again, it's just putting more wisdom on top of what I already had, and then being super cautious and asking better questions. If this doesn't work, then what? Like if we get stopped here, or the market changes, or interest rates go up, what are we going to do? So I'll give you an example. I buy properties that have rent growth in them. So we fix them up and then we grow the rents. So what happens is you get a what's called a bridge loan or a short-term loan while you're doing that. And then when it's fixed and stabilized, then you put a permanent loan on. So you have loan risk because that loan is variable. So when I did these, I bought what's called a rate cap, literally a hedge, way back when people are like, why would you buy a rate cap, right? Well, again, like I just went through this, Okay, so as you would see what happened, they started raising rates in March, and they've gone up a lot. I hit my cap, right? So I hedged my debt costs by buying this cap when everybody thought I was crazy buying this cap.
So they basically thought that was a waste of money buying this cap because it won't go there. And you're like, nah, I've been there before. It could happen. And it did.
Right. So here we are now. I've got all these rate caps in place. And the interesting thing about rate caps is they can actually pay you. So once you hit that, you actually, so we're actually making money on our rate cap. But
because interest is up here and you're paying here, you're like, there's okay, I get it.
It can work the other way. So anyway, so again, lessons that you learn by actually being in the arena, and everybody's like, why would you buy a rate cap? Like rates have been nothing for 6, 7, 8 years. Like, well, it's worth the 50 grand. Like, I'm going to do it. I don't really care what you think. And sure enough, the Fed started doing that, when inflation started taking off. So those are the kinds of things that you learn when you got the hell beat out of you, in the last time. So by the way, of course, though, there's a lot to learn still. But as you start to go through these things and make mistakes with, let's say, a lender or a general contractor or a laborer or commodity pricing or rent growth or whatever, like you start to hedge. All you're trying to do is mitigate risk, right? For that next piece. So yes, I went through a period of time where I was gun shy, but I also came out a lot more wise than I was prior, and also armed with more things to make better decisions going forward. But I never wavered on the industry itself. I still truly believe that if you can buy something and have your tenants pay it off and get massive income and tax benefits, I still think it's an amazing business. But you start to learn about some of the decisions that you made, and you just change those and refine those. And so when people come to you, say, let's do this or let's do that, it's a quick no. Nope, this is my box. This is what I do, and we're not going outside of it. And then everything inside of there, I just try to mitigate the risk as best I can.
So Ken, I just have to ask though, when you were buying those rate caps and interest rates were really low, you must have had a sneaking suspicion that those rates were going to rise, right? You just knew that at some point, I mean, not just the Fed's warning, but you had to have seen it was like, this is going to happen.
I got to be honest. I really didn't foresee it. I just knew. Well, keep in mind in 08 or 7, 8, 9, rates were where they are today, right? So I was buying then. The difference is the prices are a lot more now. So now the money doesn't work. The math doesn't work. So I came from that, saw it go all the way down, right? And I was refinancing. So if I had bought something at 6, let's say 10 years ago, and I'm refinancing at 3, I'm actually doing a cash out refi, which is tax free, of course, because you don't pay tax on debt. But I was replacing my loan with a 6% to a 3. So I was getting money and my loan payment wasn't changing the same. So I wasn't changing. So I went through that, and then we were bouncing around at the bottom. And so because I had also seen it go up, let's say in 2000, and up, and then come back down, I had been through it, but I didn't actually know whether or not I needed it or not. I just knew that it was really low and it was awesome. And the deal made a lot of sense from a financial standpoint. And I was just simply trying to hedge. It's almost like, probably not a great example, but if you're at the blackjack table and you put insurance down, you don't know what the card's going to be. And that's how I felt. I was like, I don't know, but I do know it'll kill me if they go up. So I'm going to spend 50 grand to buy these rate caps, and I did that on six projects. And, now it looks like I'm a genius, but it really had a lot to do with just again, hedging my potential problem. And it affects everybody. What affected my investors, affected all that stuff. So that one decision, and there were many, as you can imagine, that are made, but that one decision helped significantly.
Yeah. Do you think it was from being hurt in the past that like encouraged you to right? So it's like you have to be abused in the past at some point in order to make the right decisions today, or else you just won't. I mean, or just really be cautious of other people's lessons, you know, and haven't seen that. It's going to be a tricky next couple of years. Like obviously nobody can predict the future, but if you were to give your best guess on what these timelines or what the next couple of years is going to be like, how would you envision that? What would it be like?
Yeah. Okay. I have some clear ideas on that for sure. I do believe that the Fed is going to try to hit their 2% inflation rate, even if it, you know, let's say, I don't know if they're going to actually bring it down to 2%. But I do believe that's their goal right now. It's at 6.5. So I do believe we're going to see more rate increases through the federal funds rate, and I do believe that we're going to see higher unemployment. And if you look, Jerome Powell has been super clear on this. He's been very transparent on this. It's been a zillion articles. It says, I understand we might have higher unemployment and lower employment. I get, you know, so I do think that's coming. I also think that I'm not completely clear or sure that you know, people are going to see the lowering of prices like they were. So I think, you know, you're not going to see dramatic rents decline or anything like that. You're not going to see the price of I think they fuck with people on the gas, you know, to make them believe that it might go up and down. But I just don't see that, you know, really adjusting from the everyday consumer stuff like the food and the rent and, you know, tires and things that people do and buy and need. So I think that the higher costs are here. I always think back at, you know, like I always tell everybody, think about the home that you grew up in. Whatever, everybody has that home. What's it worth today? Well, that's inflation. You know, it just says, yes, it's done like this, and all this stuff's happened in between. But you know, my mom still owns a home that I grew up in, and I think they paid like 20-some grand, right? This is a long time ago, obviously. But she still owes it. I think it's worth 600 or 700 now. And you know, is she a great real estate investor? I would not say so. So you've got you have things that are going to grow and not track back based on just the inflation numbers. So I think you're going to see a lot of issues around affordability and homelessness. I think, unfortunately, I think, you know, I just did a video, actually it's coming out tomorrow on my YouTube channel, which is Ken McElroy. Go check that out. You know, we have like 310,000 subscribers or something on that now. But I kind of speak what's on my mind each week. And I do believe that the middle class is getting squeezed hard. People are working more. Their costs are driven by a lot more than their wages are suppressed as close to what they're spending and what they need. So there's kind of this whole piece between homelessness. I call it half homelessness, which is folks that are they're having a tough time, and you know they're living out of cars, and you know they're kind of living with people, and so it's horrible. So I think unfortunately we're heading there now, in a lot of areas, and there's going to be a lot of government regulations coming out in 23, 24, I believe, around housing, you know, whatever it is, and some will be really negative for the landlords. Some will be positive for the residents. I think, you know, that's fine. But, you know, there's going to be more stimulus money too, because people, you know, I think we might be going to UBI or universal basic income, where they're just starting to give people money to compensate for that. And so that's going to be not good for, you know, taxpayers. And so, yeah, we're going into a rough time, but I do believe one thing just generally, which is why I'm in rentals, is we're moving toward a renter nation. largely, and not by choice. So, and that's horrible because it's supposed to be more balanced. And by the way, I'm in the rental business, and it's supposed to be balanced. I love the rental business. It provides a need, but people should have an option that, they should be able to build their savings up and move out of a rental and buy a house. That is the natural progression. But I think that's all being compromised, and it's going to be really rough. We could forever be, for a long time. A lot of people may never own homes, which is
and unfortunately, Ken, it's not something that is a political thing that's happening. This is definitely Cantillon's effect taking place right here. The Cantillon effect, where the new money pours in and separates the classes. It's going to happen. I mean, we're already seeing it take place. During the last couple of years, we had that separation grow even more. We have even more people living paycheck to paycheck. I did a video on it just yesterday talking about how the $100,000 a year earners are now living paycheck to paycheck. There's even more of those. So the gap between the rich and the poor is going to continue to grow. And again, it's not really anything that I think politically can be done about it. It's the way that the system and the new money is pouring in. But it doesn't mean that if you are in the lower class and poor, doesn't mean you can't step out of that and step up into being a property owner, being one of the landlords and stuff like that. It doesn't mean that there's no chance for it. It just means that the gap is just growing ever increasingly more, and it's tough, but it can be done.
Right. Yes, I completely agree with you.
Yeah. We're getting towards the end here. I know a lot of people are just I'm in agreement with you. I don't see the real estate crash like a lot of people are. But sometimes I do like to imagine what that would look like. How would that take place? If there was a crash in real estate, what do you think would spark it? During the great financial crisis, it was the toxic mortgage-backed securities that really did it. All these toxic mortgages that were in the system. We really don't have that today. If there was some sort of housing market crash, what do you think would spark it? How would that happen?
Yeah, so I've been through a couple. The 08 one was a little more complicated. But what happened there was a lot of people were getting loans that shouldn't have gotten loans, and eventually, when they couldn't pay, that's the simplified version. Go watch the movie The Big Short. Get it.
Excellent movie.
Yeah. Today, it's a little bit different. I think that we're heading into an affordability problem. I think that the middle class is getting squeezed, to your point, and that's actually what's slowing things down. But the Fed can keep it going if they lower rates, because the lower rates, all they did is they created bubbles. That's it. So, when you have these teaser rates, people are buying RVs, they're buying, toys, they're buying cars, they're buying homes, whatever. That's what low rates do, is they create asset bubble. So what's happening now is the asset bubble is coming down. But what hasn't changed is that the affordability piece. So I think we're heading into a very large problem around homelessness, around affordability. There's going to be a tremendous amount of pressure on landlords and property managers and homeowners around that issue. How it spills out, I'm not quite sure, but it's become a problem. I just was reading this morning, Elon Musk himself is partnering with a big national builder to build homes in Austin just to provide workforce housing for his employees. So I think you're going to see a lot more of that. Think of Google. Google's in the Silicon Valley area. Who can afford to live out there, really? Other than rent. So, these problems are happening everywhere. So I think that you're probably going to see a lot of more corporate involved. Blackstone is coming out, and they're in the single family space. So all those trends are happening. But if there was a real estate crash, all that would happen is the government would come in and save it again. And that would negatively affect everything again. And, it depends on where the money goes. So in 2008, the money went to the banks. And in the pandemic, it went to the people. So, that's the inflation that we're seeing now. And so it depends on where the money goes, but there's no question in my mind that the government will have to write checks to somebody. And it might be to a lot of people. I did a video, actually the one I was telling you about coming up tomorrow. Just California has allocated 3.4 billion with a B to homelessness in 2023. So think about that. Like that's just for homelessness, and just Google that. Say, what did Governor Newsom approve for homelessness for 2023? And you'll see it'll come up. I couldn't believe it. Think about how much money that is. So you're going to start to see. So that's going to start cracking the coffers of some of these cities. But I think we're heading into an affordability problem that potentially could be the crash, because if people don't have money to buy something, they won't. They're just gonna be paying rent or trying.
Man, Ken, I would love to sit out here and talk with you some more, but I got to go back into work. I'm just out here on my lunch hanging out with you and really enjoying this conversation. I know our viewers are going to want to follow some more of you. I'm going to put a link to your YouTube channel down there in the description so everybody can go and subscribe to the channel. Where else can they find you?
Yeah, just kenmcelroy.com, and you'll find everything you need there. Obviously, our company is MC Companies, so that's really what I do primarily is real estate investing. That's what I love, and I love the education part, and that's all at kenmcelroy.com. So either one, and it's been a pleasure as always. Great seeing you again. I love your channel, and
thanks,
keep pumping out some good stuff.
Man, I appreciate it. And you keep sticking to it with all the hard work you're doing and showing people how it is that they can, enjoy this freedom and independence on their own through the real estate market. I really appreciate you taking the time to share this with us.
Of course. Anytime, man. Always great seeing you.
All right. I'll talk to you later, Ken.
See you, man.